Hello and welcome to the latest trades and tutorials video. This is Jeff Bish, president of MarketGauge.com, and in this video we're going to take a look at how serious the SPYs are sitting here at the 50-day moving average along with the Dow and the Qs and IWM. And this is actually a follow-up video to a video I put out over the weekend called Market Outlook, which you can find at MarketGauge.com/tutorials. And before we get started with all this, I want to make sure that if you're just finding us on YouTube, that you please subscribe to our channel. And as I just mentioned, you can find more videos like this at MarketGauge.com/tutorials, as well as more information and more trading ideas if you follow us on Twitter at Market Minute and at Market Gauge. And if you're seeing this on Facebook, also please like us. And finally, to see this in HD, all you have to do is change your settings in the lower right hand corner and it'll be a lot clearer. Alright, so as I said, this is a follow-up video to the Outlook video that we put out every weekend, and I did it this weekend, and my title was "The Bulls Are on Thin Ice." And so now today I just thought it would be advantageous to follow up with a little bit more focused or even short-term ways that you can take advantage of this key level in here. So yesterday, or Friday's low, is a really important level. I'm doing this towards the end of the day on Tuesday, so I'm not really sure how it's going to close. But if we break down through these levels, it is really a serious breakdown here, not only because we're breaking the 50-day moving average, but because of a lot of underlying weakness in the market right now. And that's all covered in the Outlook video. This video just wants to emphasize the fact that you really understand how to read what the 50 and the 200-day moving average are telling you. We call them market phases. We're going to have a webinar on that this week. And as you can see, the SPYs are breaking their 50. The Qs, on the other hand, have already broken their 50. They rallied back up to it, and now they're heading back down. I want to make sure that they don't break these levels in here. And if they do, as I said, it's pretty serious. Now, IWMs also are breaking their 50 and their 200, and they're well below their 50 and 200 as of right now. Doesn't look like they're going to come back and close over the Friday low. If they do, that would change things a little. If they don't, we've now got IWMs and Dow breaking below the key levels. Now, in order to be a little more finite, or I should say a little more precise in timing your entries here, you can use another technique that we've taught you in various webinars if you've attended them, and that is the opening range concept. Now, I can't teach you the entire concept in a few minute video here, but I'd encourage you to find the opening range information on our site or attend a webinar that has something to do with it so that you can understand some very powerful concepts like this simple one I'll share here, which is the opening range is the first 30 minutes of the day. So if you take the high and the low of the first 30 minutes, which I'm drawing on the SPYs here, if you trade above that, you're in a bullish mode. If you trade below it, you're in a bearish mode. That's a pretty simple concept, but it gets even more powerful when you apply it to the markets by looking at it the same way we look at our daily charts, which is you look at the SPYs and the Qs and the diamonds and the IWMs all together, and you look to see if they're all doing the same thing. So you'll notice yesterday, which was Monday, we came into the markets with a pretty ugly looking close on Friday. You can kind of see the end of it here. And we were at this breaking point that I'm pointing out again right now. And if the markets had gone lower, it would have been quite ugly. But the markets didn't go lower. In fact, they went substantially higher. So how would you know that that was a day that you didn't want to look for the breakdown to happen? Well, if you look at what happened yesterday, the SPYs broke above their 30-minute opening range. So did the Dow. So did the Qs. And so did IWM. So they were all going in the same direction. Some of them had outstanding moves. As you can see, the Qs had a really nice move to the upside. So did the SPYs. That was the direction to be in. All right, but today was a completely different story. the markets did not follow through at all. In fact, if you look at the IWMs over here on the right, lower right, I draw in the first 30 minutes, you can see that IWMs kind of waffled in the first 30 minutes to an hour, and then they broke out, looking like they were going to attempt to move higher after Friday's move, and being a little behind on Friday, that would have been a rational expectation. But a experienced or knowledgeable trader, someone who understands the opening range, would have known this is not a breakout that you want to follow. In fact, it's a bit misleading, and when it starts to roll over and come back into the opening range, it's even more dangerous. Why? Because if you look what the Qs did, the Qs came down to the low of their opening range, rallied just a little bit, and never got anywhere close to the high of their 30-minute opening range. And that same story played out in the SPYs, not even close. In the Dow, not even close. So as IWM is breaking down from its high, Qs are actually breaking down towards the low of the day. SPYs are at their lows of the day. All right. So when they all break down below the low of their opening range today, the market fell out of bed. All right. Now, this should not have really surprised anyone who understands how the opening range works. All right. That's one way to look at it. That's a really basic way to look at it. But even if you stick to the basics, as I said, now is the time where it's going to be really important to be able to time your entries on an intraday basis so that you don't get caught in what could become a pretty substantial down move. Or if this manages to hold and take out these levels and start working to the upside, we could have really wrung out the bears, and it could be a substantial up move. All right, so we're at an important inflection point. The Fed releases information this week, more earnings this week. There's a lot of catalysts that could drive this market in either direction. So be careful, watch your opening ranges, and watch those phases, because we're definitely at one of those points where phase change could lead to a really substantial move. Hope that helps, and I'll see you in the next video.